So in mid-June, the Federal Reserve raised interest rates once again. Now, one might have expected that given that U.S. interest rates were heading higher, while European interest rates are essentially stuck at very low levels, that would have been good for the U.S. dollar and bad for the European currencies like the British pound and the euro. But instead, the exact opposite has occurred. We've seen a rally in the euro, a rally in the British pound, and a sell-off in the U.S. dollar. So why is it that the Fed's move had no impact on the currency markets? Well, the answer is pretty simple. The answer is because the Federal Reserve's move was widely anticipated. Whereas on the other side of the ledger, over in Europe, a couple of unanticipated things happened that turned out to be bullish for their currencies. First, at the ECB meeting, Mario Draghi, the president of the ECB, essentially indicated, perhaps somewhat unintentionally, that they're going to have to begin curtailing their expansion of their balance sheet or their quantitative easing program. Now, he issued a clarification the next day, saying that that's not really what he meant to say. But everybody knows that at some point the ECB is going to have to stop buying bonds. And the reason is very simple. Legally, the ECB is allowed to buy only about 1/3 of each bond issue. And as they approach that limit, they're going to run out of bonds to buy. So that's going to be an issue for the ECB going forward that could be relatively positive for the euro as a currency. Secondly, the Bank of England also issued sort of a surprise of its own. It turns out that at the most recent BOE meeting, that 3 of their members voted to increase interest rates. Now, this implies that the Bank of England might begin following the Federal Reserve on a path towards higher interest rates sometime in the near future. That also turned out to be a bullish signal for the British pound. Now, there's still a great deal of divergence between U.S. interest rate policy, which is in a full-fledged tightening cycle, with more Fed rate hikes likely to come, as well as a reduction in the size of the Fed balance sheet, and the still relatively easy policies in Europe. So we're not sure that this recent rally in the euro and the British pound are going to prove to be long-lasting. A lot of that will depend on whether or not the Federal Reserve surprises market expectations to the upside. So here in the United States, we see a pretty big divergence between what the Federal Reserve says it's going to do and what markets believe that they're going to do. Essentially, the Federal Reserve and the markets agree on one thing, which is that the Federal Reserve will only have one more interest rate increase this year in 2017. But where they begin to diverge is what happens in 2018 and 2019. The Federal Reserve seems to think that it's going to increase interest rates 3 times in 2018 and 3 times in 2019. Now, if it winds up doing that, it's going to surprise the markets, which expect only one interest rate increase for each of those 2 years. And that would probably be very bullish for the US dollar, and it would probably be bearish for the euro and for the British pound. Now, on the other side of the ledger, we also have to think about what the European Central Bank and the Bank of England might do. Now, the Bank of England cut rates from 50 basis points to 25 after the Brexit referendum. They could just put them up to 50 basis points and stay there. That might be initially supportive for the British pound, but would probably ultimately be unsatisfying if there were no further moves to tightening policy. The British economy is sort of laden with debt and with very high real estate prices. Moreover, everybody in Britain who has borrowed money on a mortgage is essentially on a floating rate mortgage, or not everybody, but certainly most people. And so it makes their economy very sensitive to small fluctuations in interest rates. So the Bank of England might prove to be pretty cautious about tightening policy. Also, the European Central Bank may eventually stop their QE program, but that doesn't mean that they're anywhere near actually hiking interest rates. After the Federal Reserve stopped hiking rates here in the United States, the next interest rate increase didn't come for a year and a half later. So in Europe, ultimately, monetary support policy might prove to be relatively unsupportive for their currencies. So the recent rally in the British pound and in the euro could prove to be short-moved. But we'll have to wait and see on what happens to the relative differences between U.S. and European monetary policies. I'm Erik, Norland, Senior Economist with the CME Group in New York.